All right, we've got some big news coming out of the Bank of Canada today. And trust me, this is a decision that's going to ripple through the whole economy and land right in your wallet. They've just made their big call on interest rates. So, what did they decide? And more importantly, what does it mean for you? Let's get into it.
And the decision is in. The Bank of Canada is holding its key lending rate steady. With all the economic uncertainty swirling around out there, they've chosen a path of stability. No hike, no cut. It's a clear message that, for now, they think the Canadian economy is on the right track. And this is the magic number right here, 2.25%. This one single figure really sets the tone for borrowing costs all across the country. By locking it in, the bank is aiming for predictability, which is something we can all use right now.
So, what does holding the rate actually mean in plain English? And why did the bank make this specific call right now? Let's break it all down. The best way to think about the key lending rate is like a thermostat for the economy. Seriously, when they crank it up, borrowing gets more expensive, and that cools down spending and inflation. When they turn it down, they're trying to heat things up. So by holding it steady, they're basically saying, you know what, the temperature feels just about right for the moment. Now, this decision wasn't made in a bubble. With all the global trade tensions and supply chain headaches, there are plenty of economic storm clouds out there. By holding the rate, the bank is sending this really powerful message of confidence. It's signaling that it believes Canada's own economy is strong enough to handle these outside pressures.
So why is the bank so confident? Well, it all comes down to some surprisingly strong numbers we're seeing right here at home. The Canadian economy is proving to be pretty resilient.
And the first major piece of evidence? A really impressive GDP growth rate. Yep, the economy grew by 2.6% in the third quarter. Now, that number actually beat a lot of expectations, and it just goes to show that even with those global issues, the engine of the Canadian economy is still humming along nicely. And it's not just the overall growth. The job market is telling a really positive story, too. The unemployment rate actually dropped to just 6.5% in November, and that's thanks to some really solid job gains over the last few months. A healthy job market means more Canadians are working, earning, and spending, and that's another huge reason for the bank's steady approach. Okay, but a strong economy is only one side of the coin. The bank also has to play referee with the other side of the equation, inflation. Right now, the bank is managing this delicate economic tug-of-war. On one side, you've got global trade issues pushing prices up. But on the other side, things like falling gas prices and food prices not rising as fast here at home are giving all of us a bit of a break. And if we look at the actual numbers, Canada's main inflation rate, the CPI, has eased a bit to 2.2%. Core inflation, which kind of gives a better sense of the underlying trend, is a little higher at 2.5%. Now, yeah, both are a little above the bank's 2% target, but the key thing is the trend seems to be moving in the right direction. So the main takeaway here is that the bank is doing this careful balancing act. It's trying to keep inflation under control while also making sure it doesn't slow down all the good economic growth we've been seeing. It's tricky, but for now, they seem to think they've found that sweet spot.
Okay, so we've covered the what and the why of the bank's decision, but let's get to the most important question. What does this all mean for your money?
In one word, predictability. For anyone with a mortgage, a car loan, a line of credit, a stable key rate means your borrowing costs probably aren't going to jump off unexpectedly. It just takes a big piece of financial uncertainty off the table. This little period of stability is a huge opportunity. It really creates a secure environment where you can plan your next big financial move with more confidence. Whether that's buying a house, refinancing a loan, or making an investment. So with things stable for now, what's around the corner? Let's take a quick look at what the Bank of Canada sees on the horizon. The bank's official stance is what they call cautiously optimistic. Basically, that means they're happy with how resilient the economy is, but they're definitely not taking their eye off the ball. They'll be watching those global trade issues like a hawk, because that's where some turbulence could still pop up. So here's the timeline to keep in mind. Today, the rate is holding steady. In the short term, all eyes are on those global economic factors. And the next big date for your calendar is January 28th. That's when we'll get the next big announcement from the bank. So let's recap. We've got stability, a resilient economy, and a cautiously optimistic outlook. All this information is really designed to help you make smarter, more informed decisions. And that brings us to the final thought. The Bank of Canada has given us a rare moment of predictability in a pretty uncertain world. Our economy has proven it's tough, so the question isn't just about what the bank will do next. The real question is, what will you do next? In this stable environment, what's your next big move?